Hey everyone, hope you all are doing well. In today's video, we are going to look at what is asset allocation, what are the factors that affect it, what are the different asset allocation strategies that financial experts recommend in order to get desired investment returns, and finally, what does the asset mix of my portfolio look like. In case you are new here, then do consider supporting this channel by smashing that subscribe button. So what is asset allocation? It is basically the decision where an investor divides his investment corpus into different asset classes in order to maximize his returns while making a conscious effort towards keeping the risk at an optimum level. Now the question arises, how does asset allocation work? Well, it works due to the principle of diversification. The thing is, when an investor invests in different asset classes that are not correlated, then the benefit of diversification kicks in. What I mean is that when one asset class does not perform well, then the returns from another negatively correlated asset class would help to balance the average returns and at the same time reduce the overall portfolio risk. I personally not only diversify my money into different asset classes, but I also diversify my money within asset classes. For example, when I invest in equities, then I prefer to park at least 60% of my money in large cap stocks, 30% in mid cap stocks, and 10% in small cap stocks. Also, within these, one can diversify even further by investing in different sectors such as pharma, IT, FMCG, or even the chemical sector. Likewise, when I invest in real estate, I prefer to buy multiple small properties rather than putting all my money in one big property. There are two reasons for that. One is that smaller properties give higher rental yields, and the second is that even if one of my tenants leave, I'm still making rent income from other properties. Now, there is no one size fits all asset allocation, meaning that for every person out there, the right mix of assets in his or her portfolio will be completely different depending on several factors. Let's take a look at three critical factors that have the most impact on asset allocation. The first factor is the time horizon for a person's financial goals and objectives. If the time horizon for a financial goal is on a lower side, that is a maximum of 1 to 2 years, then in that case, the investor should choose to invest in a low risk financial instrument wherein the chances of accumulating the desired sum of money is almost certain. On the contrary, if the time horizon for a financial goal is on the higher side, that is more than 5 years, then in that case, the same investor may choose to invest in equities. The reason is simply that slow economic cycles and high volatility in the market pass by swiftly when the time horizon for a financial goal is on the higher side. The second factor is the risk tolerance level. This signifies the willingness of an investor to lose some or all of their original investment in the hope to make potentially greater returns. For example, aggressive investors typically risk a huge portion of their portfolio in order to get better returns, while at the same time, a conservative or risk-averse investor typically prefers to invest in a financial instrument wherein the original investment, or what we call the principal amount, is preserved. So crypto and small cap stocks would be the favorite for hyper aggressive investors, and fixed deposits and government bonds would be the favorite for risk averse investors. Last but not the least, for investors who actively rebalance their portfolios, market conditions becomes a big factor in their asset allocation strategy. These investors give immense importance to economic cycles, interest rate changes, inflation, geopolitical events, unemployment rates, GDP growth rate, and other macroeconomic parameters. For example, let's say that the US Fed decides to decrease the interest rates. Then in that case, the returns for foreign institutional investors becomes less, and then they would prefer to invest in developing nations such as India. This then becomes an opportunity for investors like us to rebalance our portfolio by buying more units of the broader indexes such as Nifty 50 to take advantage of the growing demand from the FIIs side. Now that you know about the three factors that affect an investor's asset allocation, let's look at 5 of the most commonly used asset allocation strategies. The first one is strategic asset allocation. Under this strategy, an investor sets a fixed mix of assets based on one's financial goals, risk tolerance, and time horizon. This strategy focuses mainly on maintaining this predetermined mix over the long term through periodic rebalancing. For example, suppose that you are 25 years old and you plan to retire by 50 years of age. You then decide on a strategic asset allocation of 60% stocks, 30% bonds, and 10% gold. You review your investments periodically, preferably every year, and rebalance your portfolio to maintain this ratio. So even if stocks outperform and bonds and gold underperform, you would sell some stocks and buy more bonds and gold in order to stick to your 60-30-10 allocation. The second strategy that is used by somewhat active investors is tactical asset allocation. Under this strategy, an investor starts with a fixed mix of assets but makes short-term changes to the mix depending upon the market conditions and the economic outlook. Unlike strategic asset allocation, tactical asset allocation allows deviations from the long-term target mix. For example, suppose that your usual asset mix includes 70% stocks and 30% bonds. Now let's say that few months down the line you feel that the stock market is overvalued and there are high chances for a correction. Then in that case, you would shift to an asset mix of 50% stocks and 50% bonds until you see a better buying opportunity in stocks again. The third strategy that is used by some advanced investors is dynamic asset allocation. Dynamic asset allocation actually combines the rules of strategic and tactical asset allocation. Under this strategy, investors adjust the asset mix of their portfolio periodically based on some preset rules in order to benefit from short-term trends, but at the same time maintaining a long-term focus. These preset rules can be related to moving averages, interest rate changes, GDP growth rate forecasts, valuation metrics such as price to equity ratio, price to book value ratio, etc. Let me illustrate with the help of an example. Suppose that you start with an asset mix of 70% stocks and 30% bonds. You then choose to stick with a dynamic asset allocation strategy wherein you increase the allocation towards bonds by 5% on every dip of 10% in the broader equity market index. This rule helps you to capitalize on market downturns without abandoning your long-term investment plans. Now some of you may think, do we sell the stocks at a loss of 10%? The answer is you should look for stocks that haven't fallen much and you should sell those stocks to reallocate money towards bonds. The fourth strategy that is suggested by a lot of financial advisors is age-based asset allocation. Under this strategy, as the name itself suggests, the asset mix of your portfolio is adjusted based on the horizon of your financial goals and your age. For example, suppose that you are 25 years old and your financial goal is to save money for your retirement by age 60. In that case, your asset mix could look something like this. You can see from this table that as your age increases, the allocation towards a lower risk financial instrument, that is bonds, keeps on increasing. Last but not the least, the fifth asset allocation strategy is the core satellite asset allocation. Under this strategy, an investor basically divides his portfolio into two parts, the core and the satellite. The core portion of the portfolio is designed to provide stability and act as a long-term guiding factor. On the other hand, the satellite portion of the portfolio is used for more aggressive and specialized investments to increase the overall return potential of the portfolio. This strategy is commonly used by investors to achieve a balance between low-cost market-based returns and high-risk, high-return financial instruments whose returns we don't want to miss out on. For example, the core portion can be 80% of the portfolio and the satellite portion can be 20% of the portfolio. The core portion can be divided in the ratio of 50:40:10 in Nifty 50 index funds, long-term bonds that are sovereign-backed, and gold ETFs. The satellite portion of the portfolio can be invested in sectoral or thematic funds, individual stocks in high-growth sectors such as EV, renewable energy, or AI, or even other alternative assets such as REITs or cryptocurrencies. So there it is. These are the 5 asset allocation strategies that are commonly used by investors. An investor should carefully evaluate which strategy suits them best by taking into consideration factors such as financial goals, risk tolerance level, and the existing market conditions. I personally use the tactical asset allocation strategy to diversify my investments in individual stocks, real estate, and mutual funds. My asset mix currently looks like this: stocks 30%, real estate excluding residence 60%, and mutual funds and fixed deposits 10%. However, my next 5-year goal is to take the structure of this asset mix to stocks 60%, real estate excluding residence to 30%, and mutual funds and fixed deposits 10%. Remember that portfolios that have superior product selection and consistent asset allocation tend to outperform the market. If you are unsure which asset allocation strategy is optimal for you, then do seek advice from a qualified financial advisor. Hope this video gave you valuable insights and you were able to learn something new today. Thank you so much for watching. Like the video, hit that subscribe button, and stay tuned for my next video.